but you know what I mean? It's just like you have to, you got to learn. You got to pay to learn. I mean, that's just, so they pay, but they pay a heavy price because they learn lessons that are hard, and it can wipe somebody out. I mean, a bankruptcy is, it's devastating. I mean, it's just, it can wipe somebody out, obviously wipe somebody out, but some people don't come back from that.
Alrighty, good morning, Robert Kenneth Murillo here, broker associate with Team Maroa at Compass, Florida. License number BK3373543. What's going on, John?
Good morning, John Sepulveda, MLS 1309244, coming at you. What is this episode? I've lost track.
This is episode 12.
12. Episode 12, coming at you, the DM.
The DM, Daily Memo, Florida real estate. What's going on, John?
So first I have to update some information that I misspoke yesterday.
Okay.
Because
Well, maybe, most likely, fortunately, that's the part that didn't get recorded.
Touche. That could be it. Yeah, it definitely is. So I misread the report on Sunday with the oil, the cut by OPEC. Because I was just drinking coffee, outside, just just kind of reading. But yesterday after we did the show, I went back, obviously, and now I got the full scoop and got the information. So what I said yesterday was they were going to cut production by an additional 500,000 barrels a day.
Okay.
And that's incorrect. It's actually 1.16 million barrels per day,
Oh,
on top of the 2 million that they cut in November.
Per day?
Per day. So they cut 2 million in November. That's when, the president went to Saudi Arabia. And that's what I said yesterday. Kissed the ring and bent the knee, asking for them not to make that cut. They made the cut. They laughed at him in his face and cut the 2 million barrels a day. So now, and this was a surprise announcement on Sunday. Like, it wasn't planned. Nobody was planning for this. As it was, we talked about this last week. Gas was on this way up. I had said that because there's a shortage of there's just not enough in inventory. I mean, there's too much in inventory. Just they're not consuming. So there's gas, right? So there's the oil. The prices are still quote unquote low. So what is sort of out there is that, obviously I have no way of confirming, but that's kind of what I'm reading. What's out there, it seems to be in retaliation for the U.S. not refilling the strategic oil reserve. Because the administration has said that once oil prices got to around $70 a barrel, they would start refilling what they've already used, what they've used last year to try to keep prices down. So they used what they were going to use, but they haven't refilled it again. And OPEC said, "Oh, you're not going to buy it? Then we're going to raise the prices." And that's where we're going. So I said yesterday, $5 a gallon, 4+. I mean, I feel more confident saying $5 a gallon. We're really close to $5 a gallon.
Is that the highest? Is that the highest that it would have ever been at this
I
point?
don't know. I haven't tracked that data. I mean, I don't do anything in oil, petroleum with the stock, so I haven't tracked that data. And it's based on how much they have. I mean, and at the end of it, it's based on money. I mean, these OPEC countries, pretty much all of them, their GDP relies pretty much entirely on oil. So their oil profits are at its highest because there's less oil to be had.
Yeah.
And we're not producing it, so other countries will, and they'll charge the money for it. So it's going to be it was going to be a tight spring. Like I said, just obviously people drive more in the spring, and that's when gas prices always go up, and that's kind of what happens, right? You're just used to the spring, prices goes up. But I think people are going to be surprised a little bit more, a little extra something this spring for people. So get ready for that, because it's coming. So that was my sort of update, or just clarifying. It's quite a bit. My reaction was exactly yours. Like, this is gonna be ugly. Thank God for electric, baby. That's what I said.
It sounds like we're going solar.
Hey man, I mean, it's just you have. I mean, you have to look at the data, right? I mean, again, it's just. I mean, you have to look at the numbers and you have to see what's there, and you have to be able to read that. I mean, make some changes, make some adjustments, because if you don't read what's coming, you're just flying blind in it now. I'm learning. Yeah, I've kind of guess I've always known this, but now that I'm really like looking at this, keeping track of the data and looking at this stuff, I mean, it's just it's scary how we just kind of go about our days, and all these things are happening around us, and we just kind of go about our days, and we have no idea, like no clue, like that this stuff is happening, but it's
Yeah,
happening. So you know,
absolutely.
prepare as best as you can. If you have money in the market, then there's risk everywhere. Everybody has risk, but it's just there's risk buying a home, there's risk with everything. So it's just without the data, without the information, it's just that risk taking. It's more riskier. If you don't know what you're getting into, it's just the risk you take. It just becomes a higher amount of risk, and that's where people get in trouble. So, which kind of I guess lines up in topic, right? The topic for today.
Yeah, investment opportunities.
And I mean, I think that's kind of what happens. I mean, especially for the novice, for the not necessarily first time home buyer, but maybe somebody who's just owns one home and is looking for that investment. Sees real estate as a wealth creating tool and wants to jump in on that action. And now this world of technology, it's makes people be able to do things quicker and faster and have more access to more things. But that's a dangerous, just what we were talking about before, right? The AI, it's a dangerous tool, right? Because it's too powerful, and if you don't use it properly, then it can get you in trouble.
I mean, yeah, I mean, I wouldn't say it's a dangerous tool. It could be dangerous depending on how you use it.
That's what I mean. Like that's what I mean. Yeah, like
it's
that's
a
what makes
powerful tool.
Well, super powerful. Yeah, but that's what I mean. If you don't know how to use it, like me, high school kid, I need to do an essay, and boom, and submit a plagiarized, essay. You know what I mean? That's what I mean by dangerous. That people could get in trouble by it's so powerful that you can get in trouble by utilizing that tool and get in trouble without realizing it.
Yeah.
Think you're doing something good, you get in trouble. And the point I'm trying to make is that the correlation is you can think you're doing something smart by getting into this property, and it's actually something really dumb.
Yeah.
Because you think it's really
that depends on the information you're relying on.
Exactly. That's exactly what my point. That is exactly my point. You think you're doing something smart because it looks great. The neighborhood might be good. You might think the price is good. Whatever the situation is, and you don't dig deeper into the data, and the data could be sitting there in front of you, looking at you, but you don't dig deeper into it, and you jump into this thing. You're starting out. You're a young family, right? And you're trying to make it, and you do this thing, and you try to make it, and an investment, and then all of a sudden these surprises start coming up. And a home, I mean, you have to call everything, a home like that, like an investment opportunity, could be a money pit.
Oh yeah, absolutely.
You know what I'm saying? Like a total money pit. Oh, I know there's a movie. Oh, you seen it? I was gonna say, have you seen the movie? You probably haven't, because you're too young, right? That's usually how conversations go. I throw all these things at you that you've never heard before because you're young.
What about that other movie? I think it was with Richard Pryor, The Move.
Yeah.
Where like the guy, he buys the house, they go into it, and all of a sudden the kitchen is gone, everything is gone.
Everything's gone. I haven't. I mean, I saw that. I mean, that's an old movie.
Yeah. It's super hilarious though, but it does open your eyes to like the things you have to be
prepared for. Yeah, I mean, and the money part, that movie, it's just a little, it's exaggerated obviously in how things happen, but
for comedy sake.
But it's just that point precisely. I mean, you jump into this thing, you think it's a great opportunity, and then all of a sudden, boom, all of a sudden it's not. For example, right? Look at a commercial building. So think about this person, right? So you gotta, this could totally happen, right? We got a person who owns a home already, has been working, has been saving some money, doing the right thing, doing their things, and they get an opportunity to buy a 6-unit complex. I don't know. 2018, the market's booming, things are good, the economy's rolling, rates are low. I mean, it's a beautiful thing, right? So you go in there, you got the money saved up, you got your 30%, and you go get a commercial real estate loan. You know, at prime plus, right? So prime was 0, prime plus 4. I don't know, that's a really high number, but let's just use that for conversation. So you do prime plus 4, so 0 plus 4, your rate is 4, 5-year, 5-year adjustable rate mortgage, 6 units, they're rented, it's all wonderful, it's beautiful, and it's great, and you get your unit. Pandemic hits, maybe you had a little bit of money saved up because you were told to do the right thing and save some money. Pandemic hit, and then you got a couple of months, a few months here and there, and your 6 units, a couple of the tenants, a couple of months, they missed the payments because right, and now you got to take your emergency funds, use it. The tenants haven't paid you back yet because they're still working and blah blah blah, whatever, right? It could totally happen. But now 5 years later, 2023, the rate adjusts. Prime plus 4. Prime is 4.5, 4.75.
What about in the case where did forbearances apply to commercial loans as well?
I do not know. I do not know the answer to that. We can research that. I would guess no, because it's a commercial loan, and there's typically a lot less concessions and things of the sort for commercial. That would be my initial guess. If I had to make a guess, I would say no, but I have no idea. I haven't researched into that. That's a good point.
But I'm pretty sure
because if they did, that's even worse. That'll make the crisis a lot worse. So hopefully that's not what they did.
Hopefully not. But again, in a situation like that, let's say a startup investor, someone who started small, 6 units, which is barely over the commercial limit, which is 5 and above, right? 5 units plus
5 plus,
is commercial. But if they utilize the system correctly between a forbearance and potentially a PPP loan, then they may have been bailed out in that particular situation,
I mean, I would say just based on experience, the odds of that is slim to none.
Yeah.
But they actually knew how to do all that stuff, because again, we're talking about somebody who's just starting out. And that would be the type of commercial property that somebody who's just starting out would get into. A 5 or a 6 unit. They're not going to get into a 15, 20 unit on the first try. That'd be pretty foolish. Right. So they'll start out with something small. But my point is, that scenario I just played out could totally happen to anybody. Like you go into this thing like, 2018, like things great, perfect, and now you get there and this happens. Now rate goes up, prime plus 4. So now your rate went from 4 to 8.75 overnight for the next 5 years.
Something that I know for sure, and this is regardless of how much you know, of how smart you are, it don't matter how high your IQ is. Any and every business venture, and I've been doing the entrepreneurial thing since the age of, I want to say 11. Any and every venture, right? You're always going to need more than what you got. You're always going to need more than what you got. There's always going to be surprise expenses that you didn't count on when you were formulating the most perfect business plan, right? You're always going to get caught off guard with something that you didn't calculate. And that's why it's important, like even on the investment side of things, you want to do your analysis the right way.
You got to look at the data, and it's even further than that. I mean, there is any business that you do, you need to have, and obviously the size of the reserve, it's going to match the size of the business, right? So, but any business you do, any venture of any kind, you need to have capital that you can afford to lose. See, I notice I didn't say afford to invest
Yeah,
or afford to spend, that you can afford to lose. Like that's and that's for any, like that's the kind of mindset that you got to go in with any event, like any business that you that's the mindset. I can afford to lose this. I can afford to lose $10, or I can afford to lose 1,000 or 10. It doesn't matter what the number is. You know what that number is, but you have to be able to know that you lose that money, you lost it.
Yeah,
you don't need that money to feed the family. And that's the problem, right? People get into these things without all the data, and they think they'll take the rent money and buy food, they mingle the funds and they take the money they rob Peter to pay Paul. And when something hits, calamity strikes. And that's what the problem is. But all that is related to kind of data, right? So I guess I'm going to ask you first.
I learned a tough life lesson end of 2021 going into 2022 by just overextending myself. I thought I could do this, I could do that. I wound up shutting everything down and just going back to focusing on real estate.
Been there, done that, my friend.
Yeah.
Been there, done that. So, one occasion, unfortunately, sometimes you don't learn, and you try to do things that are not, you over leverage, you overextend yourself. You try, oh yeah, I can do that, and no, I mean, it's just, but it's really taking that time to carve out a plan. Like, so I guess what are your thoughts on investment from a realtor perspective? What is your, and I guess, and I propose I'll do the same thing. So let's lay out a plan. What is your, what plan would you give a somebody who has not owned a home? This is going to be their first home. How would you, what's the investment path? Let's see if we match on how like your approach as a realtor, and I'll give you mine as a lender, how I would have the conversation as to
somebody who doesn't own a home and they're looking to move into the home. Because
buy a home and be an investor, like be a real estate investor. Okay. I'm gonna put you on the spot.
Oh yeah.
And you put me on the spot.
Yeah, of course. First and foremost, I don't look at a single family home as an investment. I align my thoughts more or less with like the concept that Grant Cardone puts out. And a single family home by any means is not an investment. Okay. I have been, especially clients and buyers that are more my age, and they're looking to me for advice on how or where to get started. I always make the suggestion, go with multifamily. If you're not tied down to being at a particular location, and you're okay with living in one unit and renting out others, I strongly suggest doing nothing less than 3 units or better. If you can do 3 to 4 units as a first-time investment, as a startup, so that you can get the idea of what it takes to be an investor and how to manage the rental income and deciding on whether you're going to live and occupy in the unit. Maybe you might have to, if you do it on an FHA loan year 1, right? You might have to occupy one of the 4 units, but then determining, all right, do I want to manage this myself, or is the property making enough money for me to hire a property manager so that I can move on and focus on looking for my next deal, So I've been making that suggestion a whole lot. I think it's the smarter way to go, especially if the scenario you presented is this someone with a family? They got wife and kids?
Yeah. Just talk about a family that's buying a home for the first time.
Yeah. So I'll give you an example, right? My cousin, we sold his home here in Orlando. Him and his fiance went up to New York and bought a 4 unit. And now they live in one of the units, right? Each of the units, I want to say they're 2 bedrooms, 2 baths, each units, right? In New York. And the other 3 units essentially pay for the entire mortgage on that property.
Yeah, that's exactly how it is. So and we kind of almost match exactly, because that's exactly, well, actually I have this, I got a little bit different version of that, right? Because it depends how you look at it. Now, here in Florida, unfortunately, things are a little bit different because there's less supply of
those types of properties.
those type of properties, right? 3s and 4 are almost like non-existent.
Most definitely, to find those, you definitely got to be willing to
Spread.
live outside. Yeah, to spread.
Yep.
You want to
Spread
go to Ocala, you want to go to the Tampa area, maybe Winter Haven,
Yeah. So
Polk County, Hillsborough County, Marion County. That's where you're going to find those opportunities.
Those 3 and 4s, right? Yeah. So you know, here in Florida, it's you gotta there's more room to do different things because you have to like move that far if you want to go that type of property. But the scenario is simple: buy a 4 if you can, or buy a 3 if you can. A 2 is a duplex is a bit more realistic in the sense that there's a bit more properties, you know, a bit more duplexes than anything else, especially like around here. You don't have to go that far to find a duplex, right? I mean, there's not an excess of them, but I guess there's 1 or 2 more. You know what I mean?
Yeah. So there's several duplexes like in the St. Cloud area, Poinciana area.
Correct. Yeah. So a duplex is so so again, but if you're an investor, right? If we're looking at this from an investment perspective, like if you're just not, because it's an investment is just like starting a business, right? It's just a real estate business. So if you you can go the fine if you're able to like, and some people buy the house, live in the house, rehab the house while they're living in the house. They spend their year in the house, and then the year later they figure out what to do. Right? That's and that's a true kind of somebody who's going to put some sweat into it and be able to build that. Right?
Yeah, sweat equity is a good move for the investor who doesn't have an influx of cash.
Well, and that's what we're talking about. We're just talking about novice, right? Someone who wants to get into the game and
they're experimenting.
And want to learn how to play a game, and that's how you play a game. So I mean, I would do as much as you can, a 4 or 3 unit if you can, but if you can only do a duplex, then you go with a duplex. But my first home will be that, and that's where I'm trying to get my children to kind of go that route when they buy their first home. You buy a you do an FHA loan, 3.5% down, and you live in 1 unit and you rent out the other 2 or 3 units, right? Or 1 unit, depending how many you purchase. And you stay in there and you figure out, you learn, you're dealing with tenants. You know what it's like to have to deal with tenants, to get the call at midnight, my bathroom is backed up, and all those little things that you need to do when you're doing that while you're living in your own house, and you're also dealing with that at the same time. But more importantly, you have other people contributing money towards your fund, your investment fund, because they're depositing money into your account so you can have an investment, which is kind of what you do when you're a renter. You're being nice and you're helping the landlord trying to
absolutely
their account. So
somebody's
being nice to you and
their costs and building up their wealth.
So that's what people are doing, so that you start with that sort of model and 3.5%. And then you downgrade to 1. So if you buy a 3, next move is you buy a duplex. And you do the same thing, because you can do the same thing. You can move from one property to another if you're upgrading. You can still, do a conventional loan. You can do another FHA loan. You refinance the 3-family, you build up your equity, and you can conventional, and then you own a 3-family, and then you can buy a 2-family, and you can use FHA.
I'm glad you brought that up, because that's definitely a myth. Most people think an FHA loan is a one-time deal.
Yeah, well, because they say first-time home buyers. So people take themselves out of the equation. See, that's the problem. When a consumer starts going on the internet, starts looking at the information without having somebody guide them, they read FHA's first-time home buyers. They already own a home. They took FHA out of their mind, and I'm going to do a conventional loan, and they create the plan themselves.
Correct.
Which is wonderful. I mean, you can totally do that, but if you don't have the information to create the plan yourself, you're probably going to create a plan with wrong information, or information that's not the best information. Not necessarily wrong, but there's and the shortest path from point A to point B is a straight line. Not all this,
How many times can I utilize an FHA loan?
How many times can you buy a house?
As many times as you can afford, right?
Well, no, I mean, there has to be Like you cannot have two FHA loans at the same time.
Correct.
So you gotta, if you buy one, you either gotta sell the house, you
essentially one
gotta
a year, right? Because the
yeah,
FHA loan requires you
you to live
to
in the
have
property
that
12
home
months. Correct.
for 12 months a
Yeah.
year.
So you live in the property, but so you can't just, you gotta, if you buy with an FHA and you're gonna keep it, you gotta refi. And then, so if I buy a three unit and I'm gonna live in the property, I buy it, I live in it, I fix it. If I fix it, the equity's going up. The time I'm in there, the equity's going up. Then I refinance it, and here's the key: you refinance it as an investment property. You can't do what everybody does and refinances as an owner occupied, and then they go out the door and then go buy another owner occupied property. They refi the multi as an owner occupied unit. They take cash out, keep the property, and then they go put the down payment a month later on another single family home with 20% down on another conventional loan. They just refinanced the house a month ago to Fannie Mae on a conventional loan, saying they're going to live in the house. It happens. The underwriter looks at this. The underwriter looks at this and says, "Wait a minute. This is an application for Fannie Mae loan for you're an owner. You're going to owner occupied. You refinance. You did a cash out as an owner occupied." And here's a month later, or 2 weeks later, or 3 weeks later, an application for another Fannie Mae single family home owner occupied. You're lying in one of the two applications. Which one? This one or the other one? That's how it works, man. And they can totally recall the first loan. You have to pay that. You got 30 days to make your payment, so you got to run to the bank. I mean, it happens. That's how it works. So the legal and proper way to do it is you buy the house, FHA loan, you live in it, you fix it, you refinance it, you do cash out as an investment property. Yes, the rate is higher as an investment property. Yes, there's more limitations but that's how those are the rules. That's how you have to play the game. You got to follow the rules.
Yeah, that's called the Burr method.
Yeah, if you don't have the money in the cash and you got to leverage the property, but you got to follow the rules. It's going to be more expensive to that because there's some risks associated to the lender who's giving you the money, right? So that's just how that's the way you do it. So you refi as an investment property. If you need to refi, if you need to take the cash out of the property. If you don't need to take the cash out of the property, you don't refi, you don't need to do anything. It's just, you bought it as a primary residence, now you're moving out, and so you go. So but if it's an FHA loan and you're going to buy another house, then you do need to refi because you can't have two FHA loans at the same time. And you rinse and repeat because FHA allows you to use FHA again if there's if you can document the reason, right? So one reason is I live in a 3, smaller units, have a baby, family's growing, I need bigger room. I live in a 3, I have no yard, I got babies, I got a family, I want to move to a 2 with a yard. I live in a 3 and too far away from the city. Here's where I work, I need a 2 closer to where I work. Like those are valid reasons.
That's the viable reasons
to be able to do that, and that's exactly how you could do that. And then you just build it up. You got a 3, you got a 2, and now you go to the 1, right? So that's one scenario. And with the person that is looking to kind of move out, has to move out, further. And not, eventually, right? Because there's no 2s or 3s. So eventually you need to kind of do that. So another way you can do it is you can buy a small townhouse or a small condo. 3% down. Conventional loan.
Yep.
First time home buyer, you haven't owned a home in 3 years, 3% down. You buy your small townhouse, your small condo, you figure it out. This is what home ownership looks like, right? This is how we do it. Stay in there for a year, get your bearings, figure out, learn how to do it. You can upgrade, right? So if you can take your small townhouse or small condo, you can buy a duplex. Need more room. My condo's too small. I need bigger room. My kids need, so I go from a small townhouse or condo, boom, leave it rented, 3% down, go buy a duplex. This is for the person that's afraid and doesn't want to go into all this, and it's more, right? So you buy a duplex, 3.5% down, FHA loan. Keep your condo, your small townhouse, 3% down. Buy an FHA, you're moving up another neighborhood, bigger yard, whatever the reason is. You buy the 2-family, FHA, 3.5% down. Live in the house, fix it up, do what you need. You got 2 units, so now you got one unit, one rent coming from the townhouse, and one rent coming from the duplex, you live in one unit. You got 3 units.
Yeah.
House, you do what you need to do, move up. Single family home, 5% down, conventional.
Mm-hmm.
You leave the 2-family rented. Now you got 2 rentals from the single family, 1 rental from the small condo townhouse. That's 3 rental. Your single family. Now you got 4 units. You live in 1 and you rent out 3.
Yeah.
With 3%, 3.5%, 5%.
Have you heard of house hacking?
House hacking.
Yeah, that's a method it got popular over the years. It was highly spoken of on Bigger Pockets. You ever heard of the Bigger Pockets podcast?
No.
That's mostly around real estate investing. And
Okay.
house hacking is a method that they call basically when you purchase a home and rent out the rooms.
Yeah,
So
somewhat.
you move into a 4-bedroom home, you
Mhm.
rent out the 3 bedrooms individually.
Yeah, I mean that's what they like. That happens every day. Like near college town.
Exactly.
That's all that happens. I mean, that's just it's a house, and the rooms are students like
Rented
roommates.
individual. Yep,
Absolutely, yeah.
exactly.
Yeah, up north they do that a lot. And again, they got not only multifamilies, but it's the city, and it's people do that. Like houses, it's so expensive. That's how people live. People rent out rooms, not apartments.
Mm-hmm. Exactly.
So I mean, it's kind of crazy to but that's what like people are like. Would be like 5 people in a room, 6 people in a room. Like it's insane. No, seriously.
Yeah.
Yeah,
We
I'm not lying to you. Like I see like that's like that was just you see that all you're going to do a listing, show a house, and and, like there's literally you go into a bedroom. There's 5 beds in the bedroom, like tiny little
Oh
bed.
no, I was just a couple years ago before I moved to Dr. Phillips. I was in a household that it was my childhood friend. That's what he did. He bought a townhome in a brand new community, and he house hacked. And I rented a room. A buddy of his rented a room, and then another friend of his rented a room, and we were just there. We were each other's support essentially.
Absolutely, but and that a lot of people do that.
Mm-hmm.
That's why talk about it at some point. Household formations, right? That's a household
Yeah.
formation. People get together, they rent out a room, they're in there, but then when they move out of there, right? Those are usually temporary situations. Not long term.
Correct.
So you're in
Correct.
there,
Exactly.
you do what you're doing, you finish school, you get a job, you're doing whatever you're doing, right? You finish that, now you got to find a new place. That new
Mm-hmm.
place, that's a household formation.
Correct.
That kind of jumps into
Eventually he moved out. Everybody has moved out of the home. He rented it now to a single tenant, and then moved up into his next home.
and so in that, like in your example, yeah, 3 people. When you all
Well,
moved out of there
four.
before. So so let's say that 1 stayed there. He just decided I'm not doing this anymore, and you 3 left. That's 3 new households that were formed if you each went on your own.
Correct.
And that ties into, I mean, a little bit. Another one in a brief, on the sort of update on the inventory. As it's I've already explained, right? The expectation of new household formation is 1.9 million. Pace to build. I mean, we don't have enough. There's not enough new property being built to keep the demand of just the regular household formations. Never mind, people just upgrading and the regular kind of moves that people make, like in the spring market, right? Schools, they move and sell and go to another neighborhood for school. So typically the spring is where this activity kind of starts happening. And that's why real estate, the spring market it's a hot market, right? And I believe that now this I've been saying, like, rates are high, buy now because prices are going to go up. The prices are not going to. I mean, the inventory is just it's not there, and the sellers are not selling. I mean, it's just that's another kind of thing. People's not really looking at.
Speaking of that, I dropped the Orange County Market Watch yesterday.
And I saw that.
So we have since yesterday, for the last 7 days before that, we have 275 new listings, right? 364 sold. The price has increased on 89 of those on 89 listings, and been reduced the price has been reduced on 316 listings in the last week.
So people went in, put too much money, they put it in for too high.
They're starting off too high.
They're starting off too high, but that's not the market. That's just not.
Well, that's just not smart listing, right? Let's just say as an investor, if you're thinking about it, if you live in the home, you're selling your home to purchase a new home, that's one thing, right? But since this is about investment opportunities, right? For people who want to fix and flip, you don't want to go into a deal thinking all this stuff, you have all this data that it looks good visually, right? And then you're thinking you're going to make all this money. I know someone who found a great opportunity towards the Tampa area. They've been on the market 5 months. They haven't sold. The listing expired. So thinking that you can make all this money in one shot is great, right? But also you don't want to bite yourself in the ass either.
Yeah.
If you're gonna list, you want to list smart, because you can chase the market down, but the holding costs that you're incurring as a result, right? Like I'm looking at 2 listings that might be coming on the market soon for one of my sellers, and something that I produced for the listing presentation is showing them the holding costs.
The holding costs.
So one of the listings, which I'm suggesting we list at around 407,000. If you hold for 120 days, you're out $11,200. You get what I'm saying? And that could come with the greed of wanting to list much higher than the market is calling for, right? When being at that sweet spot, you're gonna get being at the sweet spot, being where the fair market value is at, right, is where you're gonna increase your chances of, one, having a multiple offer situation, and 2, getting more than you asked for.
Overbidding. Absolutely.
That's the only way.
That's where it's at. And the 80 something properties that increase the price, that's what's happening.
Yeah.
Oh, we went in too low. Well, that's because but you got, and that's what I meant at the beginning when I said it. You look at something, you think it's you get into this thing and it looks great, but you don't calculate holding costs.
Yeah.
People, and again, we'll go back to the same, like there's an abundance of information. So people go on, TV and watch these people, Tarak and whatever his name is, the blonde, his ex-wife, I forget what the name is, on HGTV, and they make these flips look so easy and so wonderful and so fun, and bang, and and I made $78,000, and I can do that. But then they added out all the other 15 times that they lost money.
Yeah, exactly.
And they have a fund that they're using. You got the person doing it the first time, and you put a listing, and now it's been on the market 120 days, you can't sell it, and then what do you do?
Exactly. You missed out. Not only did you not net what you needed to net because you didn't close, but you're losing money. Yeah. On the other one, 120 days would cost them nearly 17,000. So that one, I'm suggesting we list at 600.
You got to do the math. You got to do the math for sure, and it's part of this. So educate yourself. I mean, there's nothing else I can share with people. Is just get the data, look at the numbers, and educate yourself, and know where you're standing. Know what is the market doing, what's happening.
And also know that no matter how much you educate yourself, there's nothing is going to be a better education than actually getting started
and doing it. Absolutely. And learn as you go. And I mean, but you have to team up with a professional that's going to guide you. Because if you on your own,
multiple professionals.
Yeah, that's what I'm saying. You have to you got to have a realtor that's on top of his game and knows what he's doing and is giving you good advice, and you got to have a lender who works in the same way. Because
and then you go on your own, your maintenance team. If you're not handy, if you don't know how to fix things up,
and that's another really good point, right? So, and that's my case, right? I was late for 2 lessons: technology lessons and how to fix things, handiwork lessons. Like, ask me to look at a chart. I can look at a chart of data, and I just need to look at it, and I can tell you what it means. Like, somehow it just, or I can look at a table of data, numbers, and I can project. You know, I've done, like, I can voting outcomes, voting turnout in elections. It's a hobby, and I look at the data of previous voter history, and I can look at that data, and I can, with a pretty good accuracy, I can tell you what the projected turnout is for on election. You know what they do on election day? You ever watch election day when they do the numbers, they analyze the numbers and the charts? I'm addicted to that. I'll look at that all night. I'll just sit there and look at it because I'm reading it, I'm following, and I can see the trends and I can see the things. I love doing it. Like, that's just fun.
Yeah.
But
honestly,
get me to put a nail, get me to hang up a frame in the middle of the room, you know, for my wife, and it's like a 3-day project because it's going to be crooked after they finish, you know, and I hurt myself along the way. You know what I mean? It's just so. I learned a long time ago. I bought I'm going to start flipping properties. You know, I sell real estate. I'm in the industry, and I did it. You know, and I was lucky. I didn't lose too much. I just lost a couple of thousand. It wasn't too much I lost. And boy, did I get a lesson in, because I have to pay for everything. I don't know how to do any. I mean, I can try to put a YouTube video and try to learn how to. It just doesn't work well. That's not what I do. I work with my mind, not with my hands, I guess. I don't know, but that's just not doing handiwork. Is just not what I do. So I have to pay for everything. Like, everything you can imagine, I have to pay for.
That's when you got to become a master negotiator.
But even then, I gotta pay for somebody to come and look at anything. Like, not even, you know what I mean? It's for me to be a flipper. It doesn't work, and I don't do it. So I need to know what my limitations are, because that's just not good use of my time and my money buying flipping properties, because that's not what I can do. I need to know my limitations, right? I can see a problem. Oh my God, this is a great deal. And I've seen the deals. Oh my God, I'm in here, you know what I mean? You do the math. Oh, it's a great deal, but then, and I just move on. Like, really, that's not my thing, because I don't know how to fix things.
Yeah.
When the tenant calls you at midnight, my bathroom is not working, my toilet, my sink is, I can't go fix it myself.
Yeah.
And if you're gonna,
there's a tax for that.
Absolutely. But the thing
middle
is,
of the night phone call.
when you're starting out as an investor, that's the type of stuff you have to do. That's the difference between you making it or not. You know, those little extra expenses that are not so little, they add up really quick. So if you can do it yourself, you buy the parts and you fix it yourself, because you have to. If you're a landlord and you got a tenant, toilet's back up, you got to fix it because you're the landlord.
Something's got to get done. Absolutely.
You cannot call somebody. You can call, but you got to pay for it. You're the landlord. You're responsible for it. So if you're able to provide that to your tenants, and then you're in a better position. You have to spend less money out as you learn, right? And when you grow, when you have more, then you start paying to have somebody do it. When you first move into your home and you first buy your home, you might not like cutting the grass, and it might be tough, but if you can't afford it, you do it yourself. And then as you get in a better position, then you have somebody do it, right? I mean, that's exactly that's how it works. Same concept. So those are the things that people don't really think about. I'm going to buy a house, and then they get into this situation. They open up this Pandora box and then unfortunately the consequences are high. Foreclosure is a pretty tough consequence to deal with. It affects your life for years, in many ways, and for a long time.
For a long period of time. That's the one thing, is that to endure that level of, that's why so many, granted, a lot of success stories came out of it, but there was a lot more, those people from 2008, some people still have not yet recovered.
100%. But see, that kind of feeds, I know a lot of people. So in 2008, I was up north, doing loans, doing the same thing. You don't know how many people I know that own families, own homes up there, that did cash out refis and bought single family homes here in Florida. 2 and 3, not just one. So they're living up in Massachusetts, and they had multi-families there. Yeah. Mostly were multi-family. So they already had tenants. They had some experience managing properties. But there's one thing managing a property, a 3-unit building where you live on the 3rd floor and your tenants live on the 1st and 2nd floor, and you're there in your building every day because you sleep there and you know what's going on. That's one scenario. Or owning 1, 2, or 3 homes in Florida and you live in Massachusetts,
1,000 miles away.
You have no idea. You have no idea what's going on. Like, that's 2 different scenarios. I know a lot of people that did that.
Yeah,
They were invested. They became, again, not one house. Two or three,
multiple units.
Yeah,
and that's why I say, I agree with Grant Cardone. A single family home is not a smart investment.
It's an expense.
It's not a smart investment. It's
However,
a liability.
it's
granted the plus.
Who am I to disagree with Grant Cardone, right? I mean, but I would argue that if you're renting, it is an investment, even if you're paying the same amount of rent or slightly higher. It's still an investment because when you rent, no matter what, when you rent,
you mean if you're renting it out, right? Not paying rent.
No, I'm saying if you live in the house, you buy a single family. Because he said single family is not an investment.
Yeah.
Again, I'm not disagreeing with him because who am I to disagree with Grant Cardone, right? It's just, but I would argue that if you take somebody who is a renter and do the math, and you take that same person or somebody like with the same character, same income, same everything, and that person buys a single family home to live in over a period after 3 years, you can't even compare anymore. The graph is the homeowner is here and the renter is here. Like up top, the homeowner, the renter at the bottom on the graph. You after 3 years, you won't even compare because it's just the cost of renting is going to continue to increase because inflation, rent goes up, things happen. You know what I mean? That's gonna, and then you don't build anything. You don't build any equity. You have nothing building.
When it comes to that part, I know he shames people from buying a home, right? Totally agree. Like, if it comes to buy versus rent, buy all the way. It doesn't even make sense to be paying someone else's mortgage and or funding their retirement, right? But when it comes to looking at things from an investor standpoint, 100%, I would much rather own 50 units than 100 separate houses.
100%.
Yeah.
That's the more savvy, like that's you know what I mean? The
sophisticated
the beginner, but the problem is the beginner tries to do that and that's when they get in trouble. Or they buy multiple and without having all the data and all the information. That's where they get in trouble.
Yep.
So, but it's it's just, I guess wrap it up and say, do the numbers. Do the math.
Numbers. Don't
let the numbers look at the data. Huh?
I said, do the numbers. Don't let the numbers do you.
Do you? Absolutely.
Because liars figure and figures don't lie.
I mean, you cannot debate the data. I mean, it's just there. It's like the whole recession thing. I mean, it's just right. All the data, every single possible data point that can be used and has been used in the past to show a recession or before a recession, every single one of those data points has been maxed and met. I mean, since last year. Right. So I talked in inverted yield curve, right? The 2 and the 10, right? We talked about that. The 2 is paying more money than the 10, right? So if you put your money for 2 years, you're getting more money than you put for 10 years, right? That's a sign of a recession that's coming. When the recession starts, like another sign that they use to know the recession has officially inverted means it's coming. Like that's not it doesn't mean that, but in every recession, there's been an inverted yield curve right before it or before, right? That's just a pattern. Patterns develop. That's what data and charts are. It's all just patterns, and you see the patterns, and that's how you can think. So the pattern is before a recession, inverted yield curve. Another pattern is when the recession actually starts, the curves are no longer inverted. So the 10-year is going to pay more than the 2. Regular scenario.
It reverts. It
reverts. Yeah, it's reinverted. Yeah, so it's no longer inverted. We're almost there.
Almost there.
We are almost at that point. So, I mean, it's just data point after data point after data point. There's a recession coming. And there's people still in the news saying, oh, no recession, no recession. I mean, and so people are mixed. People don't know what's going on. But you need to prepare. You need to know what your environment is, so you can kind of, if you have money in the stock market, if you have assets, if you have things, you need to know kind of where that is, because the savvy investor, the wealthy, they have people that they pay money to look out for them. So, I mean, they can literally afford to lose it.
You either know or you pay to know.
Or you pay to know. Or you do what most people do, and is they pay to learn.
Correct.
And the way you pay to learn is, I mean, yeah, you can pay and go to school, but that's not what people usually do. The way they pay is they make mistakes and it costs them money, and that's how they learn. And unfortunately, some don't learn the first time, you know. Like my uncle, he was on the, you know, uncle was on the, you know, on the 7-year first grade program. You know, he was in first grade for like, you know, 7 years. I mean, just kidding, but but you know what I mean? It's just like, you have to, you got to learn. You got to pay to learn. I mean, that's just, you know, so they pay, but they pay a heavy price, because they learn lessons that are hard, and it can wipe somebody out. I mean, a bankruptcy is, you know, it's devastating. I mean, it can wipe somebody out, obviously wipe somebody out, but some people don't come back from that. So stay vigilant and watch the numbers. We got jobs reports this week, a lot of job data this week.
A lot of what?
Job data coming out this week. So yeah, interesting conversations. We got.
What does that mean? What are we anticipating? A lot more jobs becoming available?
Well, we don't know, right? So the we'll see this is going back to that February report, right? The 517,000, you know, jobs that appear out of nowhere. You know, we'll see what the data shows. The data from last year and this year, I mean, last month and this month, you know, they're expecting, I want to say, I think it's 200,000, the number that they're expecting. So new jobs created. So we'll see. So if it's higher than that or at that, right? Yeah. You know, we're not fighting inflation. You got to keep on raising rates. So, and if, you know, because what happens? Inflation's another lag indicator, as we explained before, right? So the last thing that goes up is inflation, jobless. You know, the unemployment is the last thing that goes up, because it's the last thing that a business owner does is lay somebody off, because that's obviously people's lives, right? So people try to do that as much as they can. They cut hours, they cut expenses, and when they can no longer do it, then they you know, they freeze. First, there's a hiring freeze. Right? You know, they stop hiring people, they start cutting hours, they start doing, you know, just cutting expenses until when there's no more, then they have to lay somebody off. So that's the last thing that happens when the layoff comes. Yeah. But the Fed is waiting for that number to say, oh, okay, no, we need to push more. We need to push more. The problem is you're going to break something, because it's a lagging indicator. So, you know, we're already dying, and you're still cutting out the supply of oxygen, and you're making it worse. So it's an important number, you know, in that sense, right? Because what the numbers say, and that'll determine a lot in the market. Like bond now, you know, last Friday rates went up a little bit. Now it's kind of tracking, and it's kind of there, it's just kind of waiting. So we'll see what the numbers are. Not much expectation though for a big swing. Right? It's next month, May 10th. Yeah, that's the date.
All right, so we're gonna see. With that said, I'm Robert Murillo, broker associate with Team Aroa at Compass, Florida. License number 3373543. Let them know, John.
John Sepulveda, MLS 1309244. Thank you for listening, and we will talk tomorrow.
All righty. We hope this information was valuable, and we are closing in on episode 12.